This morning, when you examined the government bond marketplace, you encountered something resembling a crime location. You witnessed the financial equivalent of observing a trusted associate pulling out a blade. You observed a supposed partner betray the American currency. The instrument of that betrayal involved $1.2 trillion in American government obligations, getting liquidated by a nation we previously reconstructed, protected militarily, and considered our principal Pacific region associate. Japan, the ally we've maintained since post-1945, has just commenced what constitutes the most extensive coordinated liquidation of United States securities in contemporary times, and the financial broadcasting networks are describing it as a simple currency balancing measure. That characterization is inaccurate. This represents an emergency measure. This constitutes an involuntary asset clearance. This marks the genesis of the extinction of the bond marketplace infrastructure as we've experienced it. Let me describe what this marketplace looks like right now. On January 6th, 2026, at precisely 8:47 evening Eastern Zone, the Japanese Monetary Authority distributed a communication. Not through traditional conference addressing, not broadcast presentation, simply a document posted on their website, originally in Japanese, with a translation supplied afterward. The communication discussed investigating approaches to prevent currency deterioration. That phrasing represents central bank communication code that constitutes the vocabulary utilized prior to significant financial market disruption. 90 minutes afterward, the futures marketplace for government bonds trading overnight in the Chicago Exchange experienced catastrophic decline. Not gradual reduction, not systematic sell-off operations, catastrophic movement. Mechanical trading systems identified the liquidity event prior to any individual financial analyst on mainstream finance even examined the communication. By 11:15 in the evening, the interest rate on 10-year government instruments experienced an elevation of 42 basis units. That magnitude doesn't characterize standard market oscillation. That represents fundamental market structure failure. That's the result when a significant investor transitions from acquiring to aggressive liquidation. And here's what financial communications platforms intentionally exclude from their reporting. As of December 2025, Japan maintains $1.1 trillion in American government instruments. That positions them as the principal external holder of American sovereign obligations, surpassing China by magnitude. China has methodically diminished their position beginning in 2022. Their current position stands at $800 billion. Yet Japan continued purchasing. Japan kept participating in offerings. Japan kept transforming their export earnings into government securities because that's what participation in financial alliances requires. Military protection gets exchanged for fiscal assistance. That constituted the foundation of post-1945 monetary structure. That arrangement just experienced termination. Before advancing further, I must convey something critical. The algorithmic systems are endeavoring to restrict this content's visibility simultaneously. The video platform does not desire this information circulating extensively because it contradicts the controlled narrative regarding economic stability that marketplace leadership is marketing. You must activate the approval mechanism immediately, not postponed until completion, not after consuming the complete presentation. Immediately, because unless this content achieves critical momentum within the initial 30 minutes, it gets eliminated from public visibility. Nobody will encounter this information, refuse to permit suppression, activate the approval, and establish this content prominently for broad distribution. I'll demonstrate using quantitative information because the statistics are genuinely extraordinary. Japan's monetary unit, the yen, has experienced continuous deterioration starting from 2022, when the Federal Reserve commenced raising its lending costs. During January 2021, $1 American dollar exchanged for 103 yen, ordinary stability. By October 2022, a single American dollar exchanged for 152 yen. That constitutes a 47% currency deterioration across 21 lunar cycles. The Japanese monetary institution attempted defending their exchange level. They allocated $62 billion throughout September 2022, attempting currency stabilization. That intervention proved unsuccessful. The yen persisted declining. By December 2024, we experienced 157 yen exchanging for a single American dollar. Presently, in January 2026, we've achieved 161. That represents a currency experiencing acute distress at historical lows. And understanding the significance of this reality matters substantially. Japan constitutes the third largest economic entity globally. They require external supply of all foundational inputs. Petroleum, combustible gas, agricultural products, unprocessed materials, everything denominated in American dollars. Currency collapse generates exponential expense increases on imports. Inflation accelerates dramatically. Populace concern intensifies. The Bank of Japan encounters precisely a pair of alternatives: They can elevate borrowing costs to defend currency value, or they can distribute their dollar reserves, buying yen and artificially supporting the exchange relationship. However, a significant barrier emerges. If they increase costs, they collapse their domestic marketplace. Japan's governmental obligations relative to economic output reach 264%. That constitutes the maximum proportion in economically developed nations. Their government structure cannot accommodate higher expenses. It would generate unstoppable governmental obligation deterioration. Therefore, they must distribute dollars. They must liquidate securities. That's precisely what's unfolding currently. Let me illustrate the operational aspects because this is where consequences become severe. Japan maintains their securities not simply in isolated storage. They utilize them as guarantees in the repurchase marketplace. They employ them multiple times to finance their own monetary system. Once they liquidate securities, they extract guarantee materials from the worldwide monetary infrastructure. That generates a liquidity deterioration cascade. The automated systems identify guarantee withdrawal. They position themselves ahead of subsequent liquidators. Fundamental structure flips, selling intensity multiplies. Suddenly, the complete government securities marketplace prices in involuntary liquidation instead of standard offering activities. The evidence substantiates this is presently occurring. Let me present the definitive proof. Throughout January 3rd, 2026, the American Treasury conducted a 10-year obligation offering, standard issuance, $17 billion. The proportion of demanded to available securities arrived at 2.18. That's inadequate. That falls underneath the 12-month expectation of 2.4. The proportion of secondary purchasers, generally representing external governmental economic institutions, represented 54%. That constitutes the minimum percentage since March 2020. Translation mechanism. External customers are departing from offerings. The recognized market-making organizations, the major banking institutions, obligated to purchase unallocated instruments, got assigned unsold portions. Those banking entities don't desire maintaining extended timeframe government securities during an environment of climbing interest rates. Therefore, they instantly established defensive measures by executing short selling in the futures marketplace. That selling momentum feeds into automated system liquidation. That generates an unstoppable deterioration mechanism. Now, let me examine what the Chinese government has been accomplishing, because this represents the geopolitical measurement that remains unmentioned. The Chinese administration has systematically diminished their government securities position beginning in 2022. They decreased from 1.1 trillion to 800 billion. However, they accomplished this gradually. They extended this transformation across 36 lunar cycles. They reinvested the resulting money into precious metals and unprocessed materials and emerging market infrastructure undertakings. That approach demonstrated strategic planning. That demonstrated mathematical calculation. Japan doesn't maintain those alternatives. Japan experiences compelled liquidation across substantial magnitudes and within compressed time schedules because their currency is collapsing at this moment. This constitutes not a deliberate financial reallocation. This constitutes a monetary emergency situation. And here's the element that should produce substantial concern. Assuming Japan liquidates 1.2 trillion in government securities throughout the upcoming 12 cycles, somebody must obtain them. The Federal Reserve isn't purchasing. They're reducing their monetary supply. The European Monetary Authority isn't purchasing. They confront their own governmental obligation difficulties with Greek-related cost dispersions increasing dramatically. The Chinese government isn't purchasing. They're liquidating. So what's remaining? American domestic purchasers. American retirement savings plans, American financial guarantee organizations, American individual investors. And they'll exclusively purchase, provided the interest compensation sufficiently addresses the possibility of loss. That requires interest compensation to increase substantially. Let me supply historical background because this occurrence has materialized previously. During 1971, the American president discontinued gold redemption because external monetary institutions, especially France, were transforming American currency into precious metal and evacuating the gold repository. The post-1945 financial framework deteriorated because the mathematical foundation no longer operated. Throughout 1985, the Plaza Conference imposed Japanese currency strengthening to decrease their commercial surplus with the United States. That created Japanese asset value inflation and extended periods of economic stagnation. During 2008, an investment organization called Lehman experienced failure because the temporary lending marketplace solidified once organizations declined delivering mortgage-connected instruments as guarantees. Consistently, those crises encompassed a guarantee material difficulty, a liquidity phenomenon, an involuntary liquidation, and we're experiencing it again currently with Japan and government securities. I encourage you to substantiate this information because conventional financial networks are misrepresenting circumstances. Visit the discussion area immediately and communicate what you're observing. Are government obligation interest rates climbing in your financial account? Are external investment accounts demonstrating negative cash movements? Are the financial personalities on mainstream broadcasting minimizing this as standard oscillation? I require your observations because the accepted communication is manipulated and the statistics transmitted through broadcasting is carefully selected. Communicate in the discussion section what authentic marketplace activity demonstrates. Function as my marketplace intelligence gathering. Now let me clarify precisely how the algorithmic systems will exploit this circumstance. The government securities marketplace ranks as the most accessible investment market globally, 24 trillion in existing obligations. However, accessibility isn't distributed uniformly. Substantial activity concentrates in the just distributed instruments, the recently generated bonds. The previously distributed instruments, the mature bonds, experience minimal exchange. Once a significant investor like Japan commences liquidation, the algorithmic systems identify the activity. They observe the magnitude. They perceive the haste and they position ahead of subsequent liquidators. They establish short positions in the futures marketplace. They buy defensive options on prolonged maturity bond investments. They organize for fundamental structure reversal, where the institutions creating defensive positions experience pressure to hedge through additional liquidation. That generates an accelerating mechanical mechanism until something experiences structural failure. Something will experience structural failure. Let me communicate what that breaking condition resembles. The Federal Monetary Authority maintains implicit objectives for the 10-year interest compensation percentage. They communicate this silently, yet the algorithmic systems comprehend it. The algorithmic systems mathematically reverse engineer it, utilizing the federal institution's monetary supply operations and their temporary lending marketplace functionality. Currently, that undisclosed objective hovers between 4.2 to 4.6%. We're presently at 4.5. Should Japan's liquidation propels us beyond 4.8, the federal institution confronts a determination. Do they permit compensation to increase and endure economic contraction consequences? Or do they engage and buy government securities to restrain compensation, which signals restarting monetary supply expansion and confirming inflation isn't controlled? All alternatives produce catastrophic consequences. Permitting compensation to increase, borrowing rates for residential property climb to 8%. Expenditures for organizational borrowing multiply exponentially. Organizations maintaining operations solely via economical borrowing initiate defaulting. The credit marketplace becomes inaccessible. Equity valuations experience collapse. If they restart monetary expansion, the American currency loses international credibility. Precious metals increase explosively. Cryptocurrency increases explosively. Inflation projections become unmoored. And external currency holders expedite their escape from government securities because they understand the federal institution will simply manufacture currency to resolve the problem. And here's the element intensifying this beyond what occurs when Chinese institutions liquidate. China represents a monetary competitor. When they liquidate, the narrative structure feels manageable. Communications platforms declare, certainly China liquidates. They're leveraging their holdings. They're behaving aggressively. Yet Japan supposedly remains part of our organization. Japan constitutes the partner. Once the partner experiences compelled liquidation, it doesn't constitute antagonism. It represents desperation. Desperation transmits broadly. If Japan distributes government securities to preserve currency, what message transmits to South Korea, to Taiwan, to the UK? It communicates that the government securities marketplace has lost its protective standing. It communicates that everybody should contemplate departure strategies. Once everybody contemplates leaving simultaneously, stampeding emerges. Liquidity collapse occurs. Market-making organizations issue declarations that they cannot proceed without government authority help. Let me execute real-time calculation to communicate the breadth of this problem. Japan maintains 1.1 trillion in government securities. Assuming they liquidate 10% of that holding, that constitutes 110 billion distributing into the marketplace. The average daily exchange magnitude in the government securities marketplace totals 600 billion. Thus, 110 billion represents 18% of one day's ordinary activity. That remains manageable if dispersed throughout duration. However, should the liquidation concentrate into minimal time frame because the currency experiences continuous deterioration, the marketplace can't assimilate it without compensation climbing. Once compensation climbs, supplementary investors experience compelled liquidation, supplementary defensive positioning commences, supplementary fundamental flips occur, and abruptly you're managing not 110 billion. You're managing 500 billion in liquidation influence as the complete marketplace reorganizes. Now, let me communicate what the Japanese Monetary Authority undertakes beyond public communications, because the announced statement utilizes curated vocabulary. They're communicating with their Federal Reserve associates. They're communicating with the American Financial Ministry. They're requesting expansion of the temporary financing agreement to be broadened. A temporary financing agreement constitutes the situation where the federal institution lends American currency to an external monetary authority exchanging for their domestic monetary unit. It's an emergency assistance mechanism. It's crisis support. The reality that Japan requests it communicates how problematic conditions are. The previous instance, Japan required substantial temporary financing activation, involved March 2020 through the pandemic catastrophe. That constituted a planetary emergency circumstance. This supposedly represents an ordinary marketplace condition, yet it isn't ordinary. It constitutes a gradual crisis that communications networks avoid discussing because it contradicts their narrative structure. And the geopolitical element remaining undiscussed represents this. Japan encounters this circumstance partially due to American governmental initiatives. The federal authority maintained borrowing costs at essentially nothing for beyond a decade. That produced the most substantial temporary financing exchange operation in history. Investors acquired yen without expenditure and invested in American resources, generating 2 to 4%. Once the federal authority commenced elevation in 2022, the temporary financing exchange commenced reversing. Investors required converting American resources into yen and repaying their acquisitions. That generated ascending pressure on currency worth. Yet inflation throughout Japan persisted minimal. The Bank of Japan preserved adverse borrowing costs. Therefore, the yen continued weakening. Its chaotic volatility. Japan remains captured trying to regulate a monetary unit, getting disrupted by Federal Reserve measures, disconnected from Japanese circumstances. That constitutes the concealed expense of American monetary dominance. The United States distributes its monetary technique across the remainder of the world. When the federal authority increases, developing economies experience difficulty. When the federal authority decreases, investment bubbles inflate universally. Countries like Japan, substantially embedded in the American monetary arrangement, lose self-governing monetary management. They become regions under dominance. Once the controlling entity's monetary approach conflicts with the subject region's survival, the subject region must determine priority. Japan's determining survival. Japan's determining its monetary unit surpasses governmental security ownership. That determination brings consequences for all Americans believing their retirement accounts remain secure in a 60% equity, 40% obligation portfolio. Let me communicate one additional historical comparison. Throughout 1997, the Southeast Asian monetary emergency initiated once Thailand permitted its monetary unit to change price unrestricted, and it experienced deterioration. Instability distributed to Philippines, South Korea, Malaysia. The Worldwide Monetary Organization required participating in restoration. However, the genuine consequence manifested within the American investment company marketplace. One of the period's most advanced investment organizations, long-term capital management, possessed substantial commitments in developing nation obligations and interest compensation relationships. Once those relationships experienced extreme widening, that organization experienced $2 billion in reduction throughout a minimal duration. They approached defaulting on hundreds of billions in exchange agreements. The federal authority required arranging private enterprise stabilization to avoid marketplace breakdown. And that circumstance originated from a singular currency in Thailand. Currently, picture what materializes if the circumstance originates from Japan. Japan constitutes the third-ranking economic structure worldwide. Japanese monetary establishments maintain trillions in worldwide obligations. Japanese enterprises distribute throughout the worldwide monetary infrastructure. Should Japan's monetary situation converts into governmental obligation deterioration or banking organization difficulties, the dissemination will exceed 1997 in scope. The federal authority lacks equivalent mechanisms presently. They previously extended their monetary supply to $9 trillion throughout the pandemic. They previously utilized essentially free borrowing. They previously accomplished unlimited monetary expansion. The alternative strategies are exhausted. Subsequent crises necessitate magnified engagement, which necessitates magnified monetary unit deterioration, which necessitates magnified inflation, which necessitates magnified desperation among external monetary authorities, maintaining depreciating American currency reserves. It's an unstoppable downward mechanism, and we're experiencing the preliminary stages. The Japanese liquidation merely commenced. The government obligation offerings are merely demonstrating deterioration. The proportion metrics are merely declining. The algorithmic systems are merely setting up for fundamental structure transformation. The communications networks persistently communicate that everything remains adequate, that everything represents standard oscillation, that the federal authority maintains complete governance, that you should persist staying tranquil and continuously purchasing lesser valued investments. I need you comprehending something. I don't recognize if this media outlet remains active prior to they terminate distribution. The video platform dislikes material contradicting the endorsed narrative. They dislike communications instructing individuals to organize for monetary emergency. They desire you consuming entertainment content and consumption messaging. You require establishment of notifications, so you obtain communication when marketplace circumstances change significantly. Because once this emergency transitions to immediate crisis, once obligatory liquidations multiply, once obligation demands start propagating everywhere, you're going to lose opportunity to react. Assuming you're anticipating mainstream broadcasting to communicate guidance, you're behind timeline. You require prioritized information accessibility through this broadcast, so you obtain marketplace information presently. Activate the subscription apparatus immediately and establish notifications. Don't postpone. Now, let me communicate the temporal sequence, explaining escalation acceleration, because this doesn't represent a single incident. This represents a multi-lunar cycle development. Initial dimension constitutes present activity, minimal liquidation. Japan distributes 50 to 100 billion throughout the next 90-day period. The marketplace processes it, yet interest compensation climbs gradually. Communicators ignore it. Secondary dimension involves acceleration. Japan liquidates 200 billion throughout a single lunar cycle. Interest compensation climbs sharply. The algorithmic systems experience distress. Oscillation expands. The market anxiety metric climbs from 15 to 35. Communicators discuss it, yet frame it as government obligation marketplace oscillation without explaining causation. Tertiary dimension involves supplementary external investors liquidating. South Korea reduces their position. Taiwan reduces their position. The UK reduces their position. Currently, you've got 500 billion in coordinated external liquidation. The government obligations marketplace breaks. The interest percentages on 10-year obligations climb to 5.5%. Residential borrowing percentages climb to 8.5%. The residential marketplace stops. The credit marketplace stops. The federal institution gets compelled to engage. Quaternary dimension manifests once the federal institution restarts monetary expansion and communicates that the government obligation marketplace can't function without monetary authority purchasing. That constitutes the conclusion. That's when the American currency ceases functioning as the worldwide reserve unit, not through official communication, yet via marketplace behavior. External monetary authorities discontinue transforming their earnings into government securities. They obtain precious metals. They obtain unprocessed resources. They construct supplementary commerce structures, circumventing the American monetary unit. The United States encounters financing a $2 trillion revenue shortage utilizing exclusively American purchasers, who mandate continuously climbing compensation. That constitutes currency production. That constitutes the 1920 Weimar Blueprint. That constitutes the conclusion for all empires that debase their monetary unit to finance expenditures. Let me communicate the Brazil example, because this describes what manifests once a nation loses management of its monetary mechanisms. Throughout the 1980s, Brazil experienced persistent inflation because they persisted manufacturing currency to finance governmental expenses. By 1990, inflation reached 2,900%. The monetary unit became valueless. Individuals discontinued acceptance. They converted to American currency. They converted to physical resources. The government experienced loss of management. They manufactured contemporary monetary unit, the real, throughout 1994, and connected it to American currency to reestablish credibility. It required 10 cycles for stabilization, and that was a mid-tier economic structure. Contemplate what transpires if the United States, the manufacturer of the planetary reserve monetary unit, undergoes matching circumstances. No more dominant institution exists for connection. No worldwide monetary organization, rescue-proof sufficiently extensive. No continuing monetary reservoir exists for the continuing monetary provider. That's precisely why the Japanese liquidation carries such magnitude. It's not exclusively about 1 trillion in government obligations. It's regarding the communication it distributes. It's regarding the precedent it creates. If Japan, the most faithful American partner throughout the post-1945 era, encounters compelled liquidation to preserve its currency, what does that communicate to Chinese leadership? What does that communicate to Arabian administrators? What does that communicate to all supplementary external proprietors? It communicates that the government obligation marketplace has abandoned its protective function. It communicates that American governmental expenditures exceed management. It communicates that the federal authority experiences entrapment among inflation and deflation without positive choices. It communicates to commence organizing departure strategies. Now, let me communicate what the genuinely informed investors undertake, because that information remains unavailable to the retail investor. The investment companies execute short positions in extended time frame government securities. They obtain the inverse government obligation holdings. They obtain defensive positions on government obligation funds. They establish positions for fundamental structure reversal, where interest compensation escalates and obligation worth diminishes. The nations holding governmental monetary reserves rotate away from government obligations toward precious metals. Information demonstrates that governmental monetary institution precious metal acquisitions achieved record status throughout 2023 and 2024, surpassing 1,000 metric assessments yearly. That represents double the customary quantity. They don't obtain precious metals due to a psychological preference for physical materials. They obtain precious metals because they forfeited confidence in American currency. They forfeited confidence in government obligation marketplaces. They're altering their reserves from American monetary unit-denominated materials. The most sophisticated financial participants obtain physical silver because silver constitutes the most undercompensated material throughout the monetary metals collection. The precious metal to silver percentage currently remains at 88 to 1. The historical ordinary percentage measures 60 to 1. Throughout monetary emergencies, that percentage contracts to 15 to 1. Should we revert to even the ordinary percentage of 60 to 1, silver needs duplication. Should we decline to emergency proportion of 15 to 1, silver multiplies by 6 iterations. And unlike precious metal, which primarily functions as monetary material, silver provides commercial requirement, photovoltaic electricity equipment, electrical vehicles, contemporary communication frameworks, protection uses. The American military structure can't construct tactical apparatus without silver. The yearly shortage between mining, manufacturing, and complete requirement measures 200 million weight units. That shortage comes from previously created materials, and those reserves are diminishing. Ultimately, no more material remains obtainable, and expense must climb to establish marketplace equilibrium. Yet you can't obtain silver via the government obligation marketplace compensation. You can't obtain precious metals via the government obligation marketplace compensation. Access your regional purchaser at this moment and inquire what they are requesting for silver bullion or precious metal bullion. The additional expense above displayed compensation calculates to $4 to $6 for silver. The additional expense above displayed compensation calculates to 80 to 100 for precious metal. That represents the separation between the displayed compensation and the physical marketplace. The government obligation marketplace functions as a cost discovery apparatus for contract materials. The physical marketplace represents the actual exchange. The dissemination between official compensation and marketplace compensation constitutes the ultimate marketplace communication. And that communication transmits that the official compensation marketplace no longer represents legitimate pricing, that authentic value manifests where actual material transforms between participants, and that separation expands as doubt increases. Subscribe to this broadcast with notifications activated because once this situation converts into immediate emergency, once the compelled liquidations multiply, once the obligation cascade initiates, you won't contain extended duration for organization. The preliminary dominoes are presently beginning movement. The liquidation commenced. The indicators are emerging. The algorithmic systems are organizing for the upcoming shift. The communications networks are characterizing it as ordinary volatility while the marketplace constructs the subsequent monetary collapse. Do not exist in the position where you're viewing it happening via television and recognizing you waited excessively extended for engagement. Be organized. Be informed. Obtain the material that doesn't depend on marketplace structures, confidence, or governmental promises. The conclusion approaches. The question constitutes whether you're adequately arranged.